everyone, and welcome to lesson 11, where we will be explaining to you all the different charts that forex brokers use to understand market price. As you can imagine, market price and market movements can be highly complex, and you need to be able to capture all the information in a simple and easy to understand chart. I will show you the 3 most popular charts traders use and explain to you how to use each one. Before we start, make sure you subscribe to the channel and hit the like button. We really appreciate your support. And if you have any questions, put them down in the comments below. We always read your comments. If you are looking for a highly profitable trading system, you should head over to our website, smartforextrading.com. Make sure you like, subscribe, and turn on bell notifications. It really helps the channel to grow. Before we jump into the lesson, a quick disclaimer. Smart Forex Trading offer educational videos to help and educate forex traders. Information on this channel is for educational purposes only and should not be considered financial advice. We must advise you forex trading carries a high level of risk, and you should be aware of the risks before trading in forex. Let's now start our lesson for today. In this lesson, we will explain to you how forex traders use charts to understand the price movement of forex markets. In order to be a good trader, you need to be able to open your trading platform and instantly understand the market behavior without any deep analysis. You need information that you can process instantly. Forex charts will help you to understand any market on any time frame in an instant. In order to understand how the price of a currency pair moves, you need some sort of way to look at its historical and current price behavior. A chart, or more specifically, a forex price chart, happens to be the first tool that every trader needs to learn. A chart is simply a visual representation of a currency pair's price over a set period of time. It displays the trading activity that takes place during a single trading period. The chart can show activity a number of time frames. Typical time frames used in forex trading are 1 minute, 5 minutes, 15 minutes, 30 minutes, 1 hour, 1 day. You can even study historical price movements using weeks, months and years. Any forex market with price data over a period of time can be used to form a chart for market analysis. Charts are user-friendly since it's pretty easy to understand how price movements are presented over time. It is a quick and visual method of displaying complex market information. With a chart, it is easy to identify and analyze a currency pair's movements, patterns, and behavior. On the chart, the vertical axis represents the price scale and the horizontal axis represents the time scale. Prices are plotted from left to right across the horizontal axis. The most recent price is plotted furthest to the right. Quick fact: in the past, charts were drawn by hand. Can you imagine how much time and effort that must have taken? Fortunately for us, we now have computers, so charts are now instantly drawn by software. Before we can use a chart, we will need to understand, what does a price chart represent? A price chart shows changes in supply and demand at the time frame we have set. A chart aggregates every buy and sell transaction of that financial instrument at any given moment. A chart incorporates all current price movements. When in the future price movements change, the chart will show the prices shift change. Charts blend all market activity from the millions of market participants, whether they're small traders or banks or institutions. Whether the transaction occurred by the actions of a small trader, a currency intervention from a central bank, trades made by a robot from a hedge fund, or discretionary trades from pro traders, a chart blends all this information together in a visual format technical traders can study and analyze. Understanding all this information is critical to making good trading decisions. There are 3 types of price charts used in forex trading. Let's now take a look at the 3 most popular types of price charts. 1. Line chart. 2. Bar chart. 3. Candlestick chart. Now, we'll explain each of the forex charts, and let you know what you should know about each of them. Line chart. A simple line chart draws a line from one closing price to the next closing price. When strung together with a line, we can see the general price movement of a currency pair over a period of time. It's simple to follow, but the line chart may not provide the trader with much detail about price behavior within the period. All you know is that price closed at X at the end of the period. You have no clue what else happened. But it does help the trader see trends more easily and visually compare the closing price from one period to the next. This type of chart is usually used to get a bird's eye view of price movements. The line chart also shows trends the best, which is simply the slope of the line. Some traders consider the closing level to be more important than the open, high, or low. By paying attention to only the close, price fluctuations within a trading session are ignored. Bar chart. A bar chart is a little more complex. It shows the opening and closing prices, as well as the highs and lows. Bar charts help a trader see the price range of each period. Bars may increase or decrease in size from one bar to the next, or over a range of bars. The bottom of the vertical bar indicates the lowest traded price for that time period, while the top of the bar indicates the highest price paid. The vertical bar itself indicates the currency pair's trading range as a whole. As the price fluctuations become increasingly volatile, the bars become larger. As the price fluctuations become quieter, the bars become smaller. The fluctuation in bar size is because of the way each bar is constructed. The vertical height of the bar reflects the range between the high and the low price of the bar period. The price bar also records the period's opening and closing prices with attached horizontal lines. The horizontal hash on the left side of the bar is the opening price, and the horizontal hash on the right side is the closing price. A bar is simply one segment of time, whether it is 1 minute, 5 minutes, 1 day, 1 week, or 1 hour. Bar charts are also called OHLC charts because they indicate the open, the high, the low, and the close for that particular currency pair. A big difference between a line chart and bar chart is that the bar chart can show volatility. Open, the little horizontal line on the left is the opening price. High, the top of the vertical line defines the highest price of the time period. Low, the bottom of the vertical line defines the lowest price of the time period. Close, the little horizontal line on the right is the closing price. Japanese candlestick charts. The Japanese candlestick chart is a variation of the bar chart. Candlestick charts originate from Japan, where they were used to show the price movements of the rice market. Candlestick charts show the same price information as a bar chart but in a visual, graphic format. Many traders like this chart because not only is it visual, but it's easier to read. Candlestick bars still indicate the open, high, low, close range with a vertical line. However, in candlestick charting, the larger block in the middle indicates the range between the opening and closing prices. Candlesticks help visualize bullish or bearish sentiment by displaying blocks using different colors. Traditional candlesticks were colored white or black. If the closing price is higher than the opening price, then the block in the middle will be white. If the price closed lower, the middle block will be shown in black. Traders rarely use the traditional black and white candlesticks. They are a little dull to look at. Imagine looking at black and white candlesticks for hours. It's almost like watching a movie on a black and white television. I don't think many people will like that. Thankfully, we have the choice to use colored candlesticks. The most popular choice is red and green candlesticks. Red candles will show a price movement that closed below the opening price. A green candlestick will show a price movement that closed above the opening price. Just in case you did not catch that the first time, I will explain it one more time. We simply substituted green instead of white, and red instead of black. This means that if the price closed higher than it opened, the candlestick would be green. If the price closed lower than it opened, the candlestick would be red. In our later lessons, you will see how using green and red candles will allow you to see price movements on the charts much faster, such as uptrend and downtrends and possible reversal points. For now, just remember that on Forex charts, we use red and green candlesticks instead of black and white, and we will be using these colors from now on in our lessons. The purpose of candlestick charting is strictly to serve as a visual aid, since the exact same information appears on an open high-low close bar chart. The advantages of candlestick charting are: candlesticks are easy to interpret and are a good place for beginners to start figuring out chart analysis. Candlesticks are easy to use. Your eyes adapt almost immediately to the information in the bar notation. Research shows that visuals help with understanding complex information. Candlesticks and candlestick patterns have patterns that we can use to make decisions in our trading. Candlesticks are good at identifying market turning points, trend reversals from an uptrend to a downtrend, or a downtrend to an uptrend. You will learn more about these in future lessons. Let's now put all that information together. There are many different types of charts available, and one is not necessarily better than the other. The data may be the same to create the chart, but the way that data is presented and interpreted will vary. Each chart will have its own advantages and disadvantages. You can choose any type or use multiple types of charts for technical analysis. It all depends on your personal preference. There are several different types of price charts that traders can use to monitor the FX market. Keep things simple as you begin reading price charts. As you find your chart preferences, look for the proper balance of having enough information on the chart to make good trading decisions, but not so much information that your brain is paralyzed and can't make any decision. Finding the right combination is different for every trader, so it's important to start with the basics before you start working your way into using technical indicators. The most popular charts are Japanese candlesticks. We will be dedicating an entire lesson to Japanese candlesticks, so look out for that video. We hope you enjoyed this video, and as always, please leave any comments or questions below. We do read all your comments. And if you have not yet subscribed to the channel, hit the subscribe button and help the channel to grow. We really appreciate your support. If you are struggling with your trading, I want to mention a highly profitable and easy to use trading system. You should check out the Smart Forex Trading system. Let me show a quick video all about this amazing system. When you are ready to start trading, you will need a trading system. Smart Forex Trading have developed an easy to use and highly profitable trading system which we will share with you now.
If you're struggling to make money in Forex, you need to try this amazing trading system. I want to share with you today a highly profitable trading system used by banks, institutes, and over 90,000 traders. The Smart system tells you exactly when to buy and to sell. It's easy to follow, and it takes all the stress and worry out of trading. In fact, this is the only trading system you'll ever need. If you want to take your trading to the next level, you need to try the Smart system from smartforextrading.com. Head over to smartforextrading.com to check out the Smart system now.